Well, we didn't see a Santa Claus rally, but we certainly are in the midst of a New Year's rally. In fact, since the lows of Christmas Eve, the S&P 500 is up over 11%. And while we're not out of the woods yet, we'll obviously be seeing some more pullbacks and a lot of volatility this year. Ultimately, I continue to be optimistic, and I think this market's going higher. Yes, the economy's definitely slowing down, but it had to because the 23% increase in corporate earnings that we saw in 2018 was the result of a once-in-a-generation corporate tax cut. Of course, that won't be replicated in 2019, but what is likely is that we'll see earnings go up possibly 6 to 8%. We can argue about the number, but for illustrative purposes, let's just assume we get solid growth in 2019 and that number comes out somewhere around $170. Multiplying that by the long-term price per earnings ratio of 16 gives you a fair market value of $27.20 on the S&P 500. So let's put that on a chart and see what that looks like. For illustrative purposes, I'm going to use Yahoo Finance so you can follow along at home. Drawing in the fair value at $27.20, you can see that the market today is sitting right around 4.5% below that fair value. In my estimations, that means we're still in a buying opportunity. Although, as I mentioned, we are likely to get some pullbacks. We may go back and test that Christmas Eve low. But by pure definition, it's undeniable that we're in an undervalued market because of the fact that we're below fair value. Prices vacillate. The market is never absolutely at its fair value. During periods of fear, the market is below that benchmark, and during periods of greed, the price gets above that benchmark. That's simply the way that markets work, and as traders, we make money on that volatility. We're currently below fair value, so common sense tells me that eventually we will get back up to fair value. In fact, we've already bridged one of the barriers that was holding back the market, and that's because on Friday, the market broke out above very firm resistance. Again, not to say that we won't go lower, not to say that we won't test those Christmas Eve lows. The market always moves in a step-like manner, and it does it by overcoming resistance. And the market's already taken that first step. As for the second step, it's going to be somewhere around 26.35. That's a zone that has an extremely large amount of resistance going back to the market downturn that we saw taking place from February to June of last year. That's also a critical barrier for the market to get through because from peak to trough, the midpoint is right around 26.40. So you can see how critical that resistance will be. But again, I believe we'll get through it because it's nominally below fair market value. Once the market breaks through that barrier, there's an even more fortified zone right around 2,700. That's a nice round number. There's a firm horizontal line of resistance there. That's a major tectonic region of prior resistance and support. And let me emphasize just how much of a Maginot Line it is. It's no coincidence that this major line of support and resistance is the exact same area where the market vacillates between fear and greed, right along the axis of fair value, right where you'd expect it to be. And so that'll be a tough region to break through. But once that barrier is breached, then the S&P 500 will progressively and incrementally make step change improvements all the way up to a new record high, just like it did in September of 2018. Again, I want to emphasize, I'm confident that the market is going to go higher because the market always vacillates above and below its area of fair value. Let's just finish up by looking at this one other way. Let's take our present chart, draw in the 200-day moving average. You can see that the 200-day moving average looks like it's starting to consolidate and flatten out. The value for the 200-day moving average at a flat line is right around 27.25. Drawing in our 50-day moving average, you can see that the market is just below that. That again is a barrier that needs to be breached. And also note, the death cross of this current bear market that we've been through, that's where the 50-day moving average crosses and drops down below the 200-day moving average. That occurred right around 27.50, which again, not coincidentally, hovering just above what I'm designating as fair market value. And that brings us back to where we started this discussion, which is fundamentals. Despite all the fear and trepidation in the headlines, I read this market as being fundamentally sound with fair market value somewhere around 27.20. We'll take that for what it's worth. Thanks for watching. Be sure and listen to full audio versions of the Wealthsteading podcast. Until then, as always, this is John Pugliano wishing you the very best returns.